Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone, and welcome back to the CreditSights No More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights, and today I am joined by my favorite guest, my favorite coworker, my favorite friend, maybe, Zach Griffiths, our Head of U.S. Investment Grade and Macro Strategy. Hey, Zach.
Hey, Winnie. Are we gonna bury the lead, or are we just gonna come right out with it?
Oh, well, I guess now we have to come right out with it. All right, so I'm getting a little verklempt here, so let me just take a breath. This is our last episode of the CreditSights No More Risk Better podcast. Mom, I'm sorry to tell you, you're going to have to find a new podcast to listen to. But wait, there's one coming at you sometime in the near future, because the CreditSights parent company, Fitch Solutions, a Fitch Group company, is developing its own bigger, badder podcast that we are going to be a part of in the fall. I will be one of the co-hosts for the new Fitch podcast called Above the Fray. I'm really excited about it. I think that we have done a really good job with the CreditSights podcast on kind of a shoestring budget and operation. You know, we don't have a tremendous amount of time to devote to these episodes, and I think that we've done a really nice job of bringing together some interesting guests to talk about interesting topics. I have personally enjoyed it, and so I'm looking forward to having some more support and an official podcast studio. That will be super fun. So, Zach, will you come on Above the Fray?
Wow, I was going to ask if I could get a commitment from you on this podcast to have me on as a guest of the new one. So yes, I would love to. I can't wait. Are they going to fly us both up to New York to do it in person for that? I'd imagine we could probably find a few other justifications for a trip to New York together, but I guess we'll see.
Yeah, we can definitely maybe arrange a little road show of some sort so we can make it up there, hit up the podcast studio. You can talk about all things macro, maybe do a deep dive into our new Fed chair, because that is the big news of this week. We have the upcoming Fed meeting. We wrote a nice little chart of the day fresh off of your trip to Asia. So Zach, I'd be curious, what are our friends in Asia, our clients in Asia, thinking about the new Fed? Is this a whole new regime, or is this just kind of more of the same, or maybe to be determined?
Yeah, a lot of questions. I'd say the biggest question, or most frequent category of questions I was asked, was on hyperscaler issuance. Who's going to buy this debt? And I think it's been pretty crazy how much sentiment has shifted in a pretty short time. I'm sure we can touch on that a little bit. But the second most popular question was certainly about the Fed, what they're going to do next. I feel like there's still a lot of focus on the balance sheet, which, again, in terms of, we all think about it from the asset side. I think the true constraints are on the liability side. And until the Fed and other regulators pass adjustments to regulation reducing banks' demand for reserves, there's little the Fed can do on the asset side in terms of further shrinking. So I definitely went through that view. I know we put out a piece a few months ago now with our colleague Peter Simon on the banks team, going through some of those mechanics. It might be helpful to update that analysis and maybe start to consider what it can look like. I did see a recent Bloomberg article as some other research shops are coming out with the potential for the Fed to continue QT maybe as soon as in the next year and a half or so, which I think that timeline may feel somewhat aggressive, but realistic. And I guess what's important for markets is that if that does gather any momentum, we'll start to see that priced in. So that the other key topic that I discussed on the trip was kind of the consideration for Treasury supply and fiscal concerns. Are those creeping into what we're seeing in nominal yields today? Certainly seen a big move higher in real yields, which I think there's a positive growth component and upside surprises on earnings, at least in Q1, maybe a little bit more balanced in Q2 so far. And with that, a higher policy rate for longer, but also perhaps a higher risk premium with the situation in the Middle East seemingly devolving a fair bit over the past couple of weeks and maybe contributing to factoring in higher defense budgets globally. So if you want to add on top of that quantitative tightening, that gets a little dicey from a supply and demand technical perspective, and maybe these yield levels already reflect a portion of that. But obviously, with our second half of 2026 outlook, we did shift to a more neutral view on duration, recognizing some of these factors at play and seeing clear two-sided risks to yield. So that was definitely a view that clients wanted me to expand on a little bit while I was over there. So in terms of this week, Winnie, not looking for any change. I guess there are calls out there for the Fed to hike this week. I think the downside surprises on inflation we've gotten recently, from my perspective, should be enough to keep the Fed at bay for now. I know we've both been highlighting the idea that these task forces and the timeline there is potentially a way for the Fed to buy time and allow some of this data to come out. I'd say the counterbalance to that is probably this deterioration in the situation in the Middle East. Oil prices are well off their recent peak, but we're certainly not out of the woods there. And so inflation expectations, whether you look at inflation swaps or break evens, have been extremely well behaved, which I would think also gives the Fed a little bit more air cover to stay on hold for now if their biggest concern is inflation, which I think it's been pretty clear from the policy statement, from the meeting minutes, and from appearances from new Fed Chair Kevin Warsh since indicate that is top of mind. So I think it's been relatively hawkish, especially considering how much focus President Trump has put on cutting rates. But I think from the administration, it seems like they're going to give him some time to sort of digest and perhaps come up with some new economic data that support rate cuts in the future. But that's certainly not what the market is focused on today.
No, I would say that the market is focused on today, specifically the world of AI. I just looked at Bloomberg and it said that the NASDAQ may be headed for correction territory, which feels like a big change of pace from where we were, especially leading into that SpaceX IPO, where it was like, the limit does not exist on the positive sentiment. Have you been surprised by how quickly the sentiment has turned around to be a little bit more cautious on the AI front? Do you think that it's rates related? Do you think that it is just supply related? And I would be curious to hear, do you think that the Fed is factoring in that some of the financial conditions that looked pretty robust and, easy peasy are maybe looking a little bit more challenged, right? We had a high yield data center come to market last week that had to price at a pretty significant discount to where initial expectations were. Is that part of the analysis that the Fed is thinking when they're, clearly looking at their dual mandate of inflation and labor, but financial conditions is definitely one component of that.
Yeah, that's a great point, Winnie. And when I think about sort of the shift in sentiment recently, it sort of reminds me of October 2023 as we scrambled to explain the move in the 10-year to 5%. And I think I had a list going of about 6 things that I would mention in client meetings, starting with the Fitch downgrade, Bank of Japan signaling it might begin hiking sooner than expected, Treasury supply, kind of an adjustment, I think, to forward guidance from what back then I think we were actually increasing supply. And so we came out with a bigger increase than expected to longer tenors, et cetera, et cetera, et cetera. Not a single one of those alone probably would have produced that move higher in yield, but all of them together at least seemed to create enough of I guess you needed all of them. And so now I feel like we're kind of doing that with AI. The SpaceX IPO, which initially went well, then the bond deal goes poorly. You have Meta shift to selling compute or leasing compute from a tech attempting to gather as much compute capacity as possible. You had the Amazon deal that came back to market sooner than many had anticipated, and so it's interesting. There was a lot of concern about that. The biggest kind of question or persistent point was, well, if we're doing $825 billion in hyperscaler capex this year, which is our analyst Jordan's call, and I think pretty consistent with the street at this point, and we're going to do more next year, where are they going to be able to issue all this debt? We've already done, almost 200 billion, I think, across currencies, maybe 65% of that in US dollars, but already branching out to other currencies. Where are we going to be able to find that capacity? And if there isn't that capacity, doesn't that mean spreads have to widen or yields continue to go higher or both? And does that pull the whole market with it? I think there are some technical tailwinds still. We always go back to the money market mutual funds, how much interest those are kicking off. And really up until a few weeks ago, we priced 1.2 trillion of US investment grade debt in the first half of this year with very little in terms of blips. Interestingly, I think Amazon back in March was another blip there. So that's kind of interesting to see their decision to come back to the market. But that is a long segue to get to, is the Fed looking at this? I feel like right now the Fed is looking at AI focused more on the productivity side and what it means for the inflation side of its dual mandate. But I do think what's underappreciated maybe in the market today is a sustained downdraft in equities, kind of a reverse wealth effect, more of this uncertainty and concern around circular financing in AI, which we highlighted with our 2026 outlook, that becoming a more prominent market driver. If that starts to have broader macroeconomic implications, which I think it could if it's sustained, which some of these down moves in equities and various other asset classes have yet to really be sustained over the past couple of years, I'd say, then I think you could see that shift. Now, you need to see that, I think, in growth data and labor market data for them to be responding quite aggressively with policy. But I think that's something that no one is asking about. No one's considering the world where the Fed is cutting aggressively, Treasury yields fall aggressively, and spreads widen dramatically. I think that's interesting to consider. Maybe how little that's priced. And obviously we have that as one of our bear case scenarios, Winnie. We assign a relatively small probability to it. But I think you need a kind of large and sustained move for it to become part of the Fed's main consideration points right now. I don't know, what did I miss there? I guess I tried to tackle a lot in a fairly straightforward question.
Yeah, you covered a wide range there, but I do think it is fascinating that this year the view has unfolded very quickly that rates can only go higher or stay at current levels, and spreads can only go tighter or stay around current levels, especially when, to your point, you have this growing list of just kind of fear factor things. And July is a tough month to discern any real trends, right? Like, it's the summer, you got a little less liquidity, people are out of their seats. You're trying to figure out, how are you going to set up for the next second half of the year? Like, how defensive do you need to be in your portfolios, especially in an election year? We know that the midterms, from a true policy perspective, may not matter as much, but from a kind of foreshadowing and future casting perspective, they probably matter an awful lot, just given the wide range of views across both parties in terms of expectations for how things should ultimately unfold. And so I do think it's interesting that the kind of dominant force in the market has been yields higher to stable, and therefore spreads are going to be stable when you do have some technical and fundamental factors that are real, but could be quickly resolved by just kind of a new calendar year, right? Like when portfolios reset, it's much easier to justify taking some big swings on things that have widened out a good bit. Zach, I'd be curious, 10-year Treasury, next stop, 4% or 5%? Where are we going?
Oh man, this is super lame, but I was saying on my trip that, I kind of put it at 50-50, which I think on its own is very lame. But we had a view that the 10-year was going to 375. So we were bullish. We thought what you saw in January and February with some of the concerns around AI hitting software, that causing equity markets more broadly to roll over a bit, yields to fall and spreads to widen. That was our call for 2026 coming into this year. It was looking pretty good. Like we had nailed the macro or high level factors and also nailed the market reaction, which I think doing both at the same time has been impressively challenging in the post-COVID era, or even over the past couple of years, maybe since the Trump administration took power. As I think some of the policies he's put in place are not particularly economically constructive, or at least are inflation accelerating, and typically the market would not like that. So if I got to tilt it in one direction right now, I feel like I could see us going to 5% first. That being said, there seems to be a rally accelerating as we record this on July 28th. So, I mean, our view has shifted a lot. We were much more bullish on rates, on treasuries, and thinking there'd be more of a softer risk environment with wider spreads and lower equity prices. And we've had that at various points, but not really on a sustained basis, which has kind of been interesting to factor into our call. I think the big thing that really hasn't played out the way we expected was a weakening of the labor market. I think you could argue that it's still somewhat weak, or at least uncertain, despite some of the headline figures looking notably better in 2026 relative to 2025. Just take headline job gains at 552,000 this year versus just 116,000 in all of 2025. So I think we could return to that, Winnie. And the one thing that I've been looking at a lot is the length of unemployment for full-time workers has continued to tick up. And so I think I've heard Fed policymakers describe this labor market as less dynamic, and therefore, we do have a low unemployment rate at 4.2%. That's come with a historically lowest in the past 5 years, labor force participation rate. That's not necessarily a robust backdrop for economic growth, but you have AI, and I think we are starting to see some of the productivity gains in the high level data, and that's really an X factor, whether it be realized today or sort of priced in terms of optimism for tomorrow, which I think is certainly fair. It's just, are we talking tomorrow, next month, 3 months, 6 months, or are we talking, next 3 to 5 years, where that really becomes a bigger, more prominent part of the economy, at least in the way that we measure it today?
So, Zach, is AI making you more productive?
No, I don't think so. Not yet. I feel like I have to spend too much time thinking about how to use AI well or correctly. And so, I think the upfront investment is worth it and necessary, but I don't think I'm more productive yet. What about you, Winnie? You're the one that's almost out of tokens for the month.
I know, I feel really proud of this Claude status of being almost out of tokens for the month. I will say that it's not a particularly high level of tokens that I have been allocated, but I have found some interesting use cases for sure. And I think the more you play with it, the more efficient you can be, especially as you start to teach repeatable skills and things like that. The thing that I was just talking to our global head of research, Chris Snow, about, though, is like, I live in constant fear and have always lived in constant fear of plagiarizing something, right? Like, we read a lot for our jobs, And historically, people would ask me, how are your views contrarian? How do you differ from other strategists or whatever? And I was always really reticent to read other reports because I didn't want to subliminally like poach something or, plagiarize something, or clearly not intentionally. I don't want to do it. And the same dynamic exists with all these AI tools, right? Like, I like to use AI tools to research topics with which I don't have a deep level of familiarity, but then I do need to take a number of extra steps to ensure that what I am doing is my own product and not something that has holes based on assumptions that I'm making from the AI feeding it to me. And the tools have gotten better for sure. Like, you can create something that seems pretty reasonable, but that doesn't necessarily mean it's right. And so I think that there is this kind of dual issue where you can have a great brainstorming session, you can build a file, you can analyze data, but you still need to know the nuts and bolts of how it all works and understand it in order for work product to be really good. And then another thing that I've just been contemplating and grappling with is, in the world of AI, is it inch deep and mile wide for all information? Because that's kind of where it thrives and it excels. And is there going to be space for that truly deep analysis? Does that become more value add, more worthwhile? Um, but when you are trying to tailor research and reports to AI tools that facilitate more of that inch deep, mile wide analysis, when do you have time to do the really deep dive stuff? So I think that it's definitely a moving target. I was kind of laughing because when I was putting together the front section of the AI quarterly report, I was looking at some of the recent Fed studies on productivity and adoption of AI. And they have one study that basically shows anything that is kind of replicable by AI, they're seeing the biggest efficiency gains. Makes a ton of sense. And it had a number of different industries kind of on this little scatter plot. And financial services was kind of like below the productivity efficiency line. So, like, using lots of AI, but not necessarily particularly productive or efficient with it. And that was just kind of making me laugh because it feels very like accurate from my conversations with people in the world of financial services. There's definitely a lot of push to use these tools, and there are some really great use cases. And at the same time, it does feel like it's just adding some work onto my plate that I don't necessarily have the time for.
I mean, yeah, like, especially, I was trying to prep for this trip to Asia and make sure I, distilled all the views from our analysts in various parts of the company and had it able to deliver in a very concise way to our clients. I'm like, I don't have the time to look into this. And then when we were kind of considering the AI quarterly and this narrative or idea that investors are full up on tech debt, which would be a huge problem if true. But, is that a sentiment thing, or is that like our investors practically running up against concentration limits by an issuer or by sector? And so I asked Claude, and it puts together this robust looking model. I'm like, I don't want to review that. Like, even though it just did theoretically however many hours of work in a few minutes, I'm like, well, am I better off building it myself so that I know what's in there better? Because I don't, if you review something several times or review it slowly and carefully, in theory, maybe that's quicker. But I don't know. But my initial reaction is like, that's I don't want to review that. I would get more excited about the idea of putting it together myself, which maybe just because I'm an Excel nerd. But I feel like there are those frictions where you just don't quite know. And I think for us, in research, where the whole job or a big part of the job is to come up with new ways to look at things and new ideas, like, AI thrives in things that you can sort of create a perfect box and be like, this is my task. This is what I do. This is what I need AI to do for me. And I feel like for us, any given day, any given market, it's just not going to be exactly the same. And so having that fully replicable task that AI can do consistently for you feels like it'd be very challenging to be prominent in our job. Maybe everyone else in their jobs feels the same way, but I feel like it's maybe somewhat unique to research.
All right, Zach, we'll keep you around. We're not going to replace you with Claude this year. You've just justified your existence. Man, I'm going to have to find that budget somewhere else now.
That's last podcast. Please let me keep my job. Goal
Absolutely.
accomplished.
Absolutely. You will keep your job. So let's pivot. Let's talk about some fun things because this is the end of the road for No More Risk Better. I would love to hear, like, what is one of your favorite podcast moments or episodes or something that you've learned from talking to any of our esteemed guests and colleagues?
I think my favorite one has to be having Barry Eichengreen on with our chief economist at BMI, Cedric Chehab. I mean, he's a world-renowned economist. I had just finished reading Exorbitant Privilege. There's all this focus on the US dollar and what happens from here with some of the drastically changing policies under the Trump administration. So to be able to have him on was an honor and a just a very cool experience. But I mean, I think we've got a lot of great analysts, strategists, etc. internally, and I feel like it's been really fun to highlight their views and try to get them out on another platform. And it's also been really fun to have other external guests and kind of get their perspectives. So, but I think, having Barry on, that probably is atop the list for me. How about you, Winnie? What's a conversation you enjoyed most for whatever reason?
Well, I really liked that time where you cursed. That was pretty funny. Um, so, I think that my favorite part about doing this podcast has been highlighting the people that we work with in a different way, both within the CreditSights fold, the research analyst team. I think just the most of so many of our colleagues. They do great work, they take it seriously, and they're generally nice people, which is such a delight. And so to be able to have these more natural and organic conversations about sectors, about podcasts, Davis and I did that podcast on podcasts, which was really fun. And then also to expand it beyond just the immediate CreditSights family, talking to Carrie Canton at Levin Insights or Luke Miller over there, talking to colleagues at BMI and the broader Fitch Ratings team. It's been a really fun time and I've learned a lot. And it also makes me excited about that collaboration that we can really continue to expand upon as we pursue our new podcast endeavor. Just because it will be even more natural. There are a lot of core competencies on infrastructure and some of these data center deals that are coming to market on the Fitch rating side. And I would love to pick the brains of the analysts looking at those deals and really getting in the weeds on the mechanics of things so that I can better understand how they apply to the public markets. So I just think in general, I think anytime you ask someone like, what's your favorite part of your job, they're going to say the people. It's just kind of standard. But for the podcast, it really has been the people. You guys are great. And also I like that my mom's a listener. That makes me happy. Hey, Peggy.
I've had more of my friends listen pretty consistently, which has been a real treat. But I agree. I mean, I think we have so many great conversations internally, and I'm so often impressed by our colleagues, and it's great to be able to highlight that externally through this channel. So Winnie, I mean, other than me, can we get any guests sneak previews for the new podcast coming up, or is that are people just going to have to wait
Ooh.
and tune in?
The classified information. So we will be featuring some of our repeat guests from the CreditSights podcast. Andy DeVries is lined up to talk about data centers and utilities and the link to potential oversupply there. That's something that he has been featured on a number of different podcasts, and that view continues to expand as we see more headlines associated with some of the moving pieces there. We'll be definitely diving deeper into the consumer, which continues to be, a key area of focus for a lot of our clients. I had a client ask me recently, what do you think of the consumer? And my response was, which one? Because depends on who you're talking about. There are a wide array of how good the consumer is feeling, and consumer sentiment data actually came out this morning a little bit weaker than anticipated, probably due to gas prices going up yet again, of course. And we have a long list of different topics and internal and external guests that we want to highlight. But, the main thing is we want to be market relevant. So it's kind of hard to tee up what exactly we're going to be talking about on any given day because, just looking at how this year has unfolded, it was BDCs and private credit, it was software, it was geopolitics, US Iran, oil, energy supply, Strait of Hormuz, it's been hyperscalers, it's been private data center financing. I feel really tired, but also it's cool to learn about all this stuff. And I feel really lucky that I continue to have the opportunity to chat with people who are much smarter than I am about all of these topics.
Yes, I'd say this year has been the longest decade of my career by a long shot.
Yeah, my 6-year-old was telling me that some of his favorite YouTubers are in their 40s, which is objectively not true. They're like all 15 years old, but when you're 6, looks a lot older than that. And I was like, buddy, they can't be as old as I am. He's like, well, you're not in your 40s. Implying, I think, that I am much older than that. So that's cool. It's almost as good as the time that his preschool did one of those little like fill out the form about what your mom is on Mother's Day. Like my mom works at wherever, and they had on there my mom weighs and had them put how much the kids thought their moms weighed. Why would you do that? What was that, some sort of like GLP-1 advertisement? I'm not sure what that was all about. All right, Zach, we are truly going off. I am going off the rails. You have not gotten off the rails, but I am.
Yeah, the GLP-1 angle is that's a funny spin and been topical in the markets. We've had a podcast on that. Yeah, I mean this has been fun. I feel like we covered some fun stuff in this final episode. We covered some market topical stuff. Is there anything else we need to leave our audience with one last time?
I just want to say a big thank you to all of the No More Risk Better podcast listeners, viewers, YouTube channel subscribers. I very much appreciate your support. Doing research can be a little bit of a solitary endeavor. We put a lot of information out into the universe, and I wonder often, who's looking at this? Does anybody care? Does anyone hear me? Am I screaming into the void? And getting feedback on the podcast just proves to me that someone is out there and listening. And so thank you for taking this journey with us. I hope you stick with me for the Above the Fray podcast coming soon. It is going to be another great adventure in this roller coaster ride of a market. So, Zach, I guess we should wrap it up there, yeah?
Let's wrap it up there. Thanks to all our listeners and especially thanks to all our guests coming on. We really enjoyed all the conversations, and I look forward to tuning into Above the Fray and hopefully contributing as a guest and in any other way I can, Winnie.
We can't wait to have you. All right, Zach, I guess we'll do our mid-year review for you offline. We're not going to do that live. All right, thank you all for joining us for this very last episode of the CreditSights No More Risk Better podcast. Tune in soon to the Above the Fray podcast, which will also be available to you wherever you consume your podcast content, including on YouTube with a brand new podcasting studio and a nice little setting. Zach, thank you for being here. Thank you all for listening. And as always, feel free free to reach out to either of us using the Ask an Analyst button on the CreditSights website or reaching out to your Fitch Solutions sales coverage. With that, we'll wrap it up.
Thanks.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.